Hello, everybody. Welcome to this webinar. I'm KLCI. I'm so excited to see you. So a big welcome to this online training. This is an educational initiative brought to you by Bursa Malaysia Derivatives Berhad. So we have Warren Mark back again to show you how to stay sharp and ahead with some tactical market strategies. Is the US stock markets heading to a bubble? Warren is going to show us some data about the trend of federal fund rate and other stuff like that, right? Later, he will also put up some case study, including like Maybank, Public Bank, and TENAGA. And most importantly, if it is a bearish market, what kind of strategy can you use and you can still make profit from it? So Warren, welcome back.
Thank you, Casey. Let me share the slide.
Warren, did you just stop your own video webcam? Yeah, I see it now. Okay, awesome.
A very good afternoon to everyone. Welcome back to my third English webinar. This is the second last. The next one will be in Chinese, but for the same topic. And hopefully all of you, or at least most of you have attended our previous webinar. The first trade started by my friend Chong Ting Ting and the subsequent two from me. Because if you have not attended any of these webinars, then you may have some challenges following this slide today. But it's okay. You can always go back and review all those recorded videos from the link sent by Casey. So check it out from your email that you receive after you register for this. Okay. Today, our topic is stay sharp and ahead with tactical market strategies. Allow me to use 1 minute to introduce myself. I have 25 years of experience in the capital market, including banking, security, and derivative industry. And before I stopped my 9-to-5 work, January 2017, I worked in Bursa Malaysia for 15 years, and I was the head of 5 different departments, including 2 in derivative, which is the risk management and also product development. Subsequently, I worked in regulation and also in security market. Before I stopped working after 15 years, I set up the investor education department for Bursa Malaysia in 2013. And now I'm a full-time trader, investor, speaker, and also trainer in stock and derivative. Okay, disclaimer. This presentation is provided for academic discussion and information purposes only. The presenter and the organizer do not make any warranty, express or imply, nor assume any responsibility for the accuracy of completeness of the contents of this presentation. So, if in case we talk about any stock, that is only for education purposes only. So please seek your advice from your investment advisor before you make any investment decision. Okay, so today we're going to discuss what causes the market ups and down. Basically the price of whatever you trade in terms of stock, in terms of derivative. And also, one of the best features of derivative, especially future, is the ability to sell first. So we will discuss about this. And also strategy in a bearish market. If you trade stock and if you don't do any intraday stock short selling, technically either you stay away from the market or you just sit on your portfolio. But in derivative like futures and option, actually, you can apply some of the strategies when the market turns bearish. Of course, I will show you some of the signal in the market that you need to understand so that you will increase the success rate in your trading and investing journey. And last but not least, I will show you some of the resources that you can get more information about futures and options in the market. So what are some of the major factors that cause price volatility in the domestic and global markets? Of course, if you talk about factor, there could be more than hundreds, a few hundreds. But when you talk about the majors one, then could be only a few. And today, I just want to highlight one. The top two major factors to me is the trade war between the United States and other countries. But there are, I would say, 100 or even 1,000 articles, interview, news, and write-ups, webinar and seminar talk about this. So, and also because of that, so much development that technically you should keep up to the developments on a daily basis. And what I want to focus on today is we talk about the interest rate trend globally. And after this, you will appreciate why I focus on this single, to me, is a single most important factor. Because trade war happens maybe right now, maybe for the next 1-2 years, but all this while, we hardly heard of trade war. But interest rate to me is a single most important factor that is always the major factor no matter what. That's been for the last 100-200 years or for the futures, no single company can run away from the impact of interest rate. You will understand more when we go in more deeply. Before I talk about interest rate, of course, in your mind, and also a lot of people always want to find out is US stock market bubble is going to burst. Yeah. Yes, to me, the bubble is getting bigger. Of course, now like the size maintained, but eventually I would say it will still get bigger. And is this going to burst? To me, yes, but not so soon. Let us discuss. From the next few slides, you will be able to determine eventually, roughly, if the bubble is going to burst, when is the bubble is going to burst. Before we talk about this, let us go back to basic. Have you wondered what is a stock market? Of course, a lot of people just buy, sell stock, and then they say stock is ownership. When you buy a stock, it's ownership of a company. Yeah? So we talk about trading. We talk about what is concern us. Yeah. So basically, stock market consists of stock listed in it. Yeah. So the entire stock market have a lot of stock listed in it. They call public listed company. And what is a stock index? For example, KLCI. Of course, in overseas, we know that we always look at Dow Jones, Hang Seng Index, Nikkei, Singapore Index, Hong Kong. Why we have concern on all these indices? Like for KLCI, is a stock market index that represents the value of all 30 component stock at a single point in time. The reason why we always look at this is because of most people, especially retail investor or trader, either they don't know how to do assessment of individual counter or they have no time. So the best way for them to assess whether the market is doing right, is it going to go up further or look like it's going to go down or sideways, the most convenient, the best way for them to assess is they look at the major index in a single, in each of the stock market in the world. For example, US, they look at Dow Jones Index. Malaysia, they look at KLCI. Hong Kong, they look at Hang Seng Index. Then we should know how do we forecast the direction based on this single index. So now we know KLCI is represent the total value of all 30 component stock out of 900 overstock in Bursa Malaysia. Then what about the value of each single stock? Value of a stock reflects the past, whatever happened in the past in terms of company performance. Of course, current, because they are still doing business and making money for the company. If you're a shareholder, they are making money for you. And basically also the expected future earnings of a company. Basically, if you want to do valuation, past and even current is for you to use it as a benchmark to gauge, to do a current assessment. But if you really want to value what is the intrinsic value of a stock, basically you look at the expected future earnings. That means you do a forecast based on the current earnings, based on the company performance, based on the growth and also the business plan. What are the expected futures earning for the next 10, 20, 30 years? That is how you derive the intrinsic value of a company. But the past and current is equally important because that gives us the basis and also the confidence. How do we do assessment in futures? And therefore, earning per share is one of the most critical components to assess the direction of the stock market. Because the earning per share will give rise to the value of the company. Yeah. So the smaller units for a stock market is actually earning per share of each individual company. Then what is a major factor affecting the earning per share? Yeah. Cost of financing. Cost of financing is one of the most important type of cost regardless whether a company borrows money or not. Yeah. I put this bullet point is because of, you may say, not everyone borrow money. For example, Bursa Malaysia don't borrow money. They have a lot of cash. Some others company also cash rich. They have positive cash flow. They have positive balance in the cash. They don't borrow money. But the issue is, I would say all company cannot run away from the impact of cost. If you borrow money, of course, you have direct impact of borrowings. That means you will be subject to the impact of interest rate trend up or down. But if you don't borrow at all, you will still have indirect impact from interest rate trend because of all the input components that make up, that is needed for your business operation. If all these companies they are affected by the cost of borrowing, definitely they will increase their price. When they increase the price, they will affect your earnings indirectly. That's why, to me, the cost of financing, interest rate is the single most important element for me to assess the entire market. Yeah. So if you talk about the price earning ratio, the small formula is the price divided by earning per share. For example, if the Maybank share is trading at 10 ringgit per share right now, and Maybank declare earning per share in 2018, for example, now they completed all. It's 80 cents. Of course, you have to add up all the quarterly reporting because every quarter they will announce what is the earning per share. So after you add up all these 4 quarterly results, you get 80 cents. So you use 10 ringgit divided by 80 cents, you will get the PE ratio, the price to earning ratio of 12.5 times. So what is this 12.5 times? So if we invest 10 ringgit to buy this Maybank share, and we know that we get 80 cent dividends every year, for example, yeah, constant. Maybank share remain unchanged. dividend payout remain unchanged, then if every year we get back 80 cents as dividends, after 12.5 years, we will get back all our initial investment, our initial capital invested in Maybank share. Or we can say we have a break even in terms of years is 12.5 years. This is very important, and technically PE ratio is one of the most commonly used benchmark to determine whether they want to buy this stock or not. Yeah. Of course, in general, the understanding is we want to buy a stock with reasonable level PE ratio, not too high, not too low. Too high maybe is overvalued. Too low maybe is because of investors do not see much growth potential of this company. Because when we buy stock, technically we want to buy a high growth but sustainable stock. We don't want to buy a stock with a low PE but it's not moving. Yeah, that means forever we can't really make money from the capital appreciation. So now let's come to the significance of interest rate on stock price. From there, we can assess what is the trend of the overall. Because when we trade futures, besides trading single stock, yeah, we have the single stock futures, but the problem is it's not popular. So most people will trade on FCPO and the KLCI index. But the best way to forecast the outlook of the market is we need to know what makeup of this single KLCI. So just now we cover what is a PE ratio. Now we look at what is the impact of interest rate on stock price from the PE ratio perspective. So when interest rate increase, net profit margin or earning per share will decrease. Yeah, because interest rate will eat into their profit margin. Of course, this one is with the assumption that sales price and volume remain unchanged. So when you want to assess what is the outlook of the entire market or individual counter, you have to find out, can they easily increase the sales price for their product or services? And also, can they increase the sales volume if the sales price remain unchanged? If they can't, then definitely when interest rate increase, net profit margin or earning per share will decrease. So when earning per share decrease, what happened to PE ratio? PE ratio will increase. Remember, PE ratio is price over the earning per share. So when earning per share shrink, P constant, the PE ratio will increase if stock price remain unchanged. Yeah. But for us, we only want to buy and hold stock when we see the PE ratio is at the level that we are comfortable, at the level that we think that it is reasonable, fair. When the PE ratio keep on increasing, to a certain extent, we said that maybe we should let go of the stock. That means we want to sell the stock because of the PE ratio is higher than what we think should be the fair PE. Yeah. So in order to maintain the PE ratio, that means in order for us to buy into the stock again, stock price have to drop. Because now we know that interest rate go higher, earning per share go lower. If the price remain unchanged, the PE ratio will goes up. But when the PE ratio goes up too high, we will not want to hold the stock, so we sell. Yeah. So when we sell, stock price will drop. So if a lot of people sell, and when the price of many stock drop, market will crash. Yeah. So very simply, if we know that interest rate trend is going to be higher and higher, and earning per share will not be able to increase accordingly, PE ratio will goes up. When PE ratio is too high, investor will want to let go of the stock to go for a better valuation stock. Then when everyone sell, this will cause the price drop of an individual counter, and when a lot of counter price drop, then this will lead to the market overall on the downside, and normally we term it like major correction, or we call market crash. So in order for us to know what happens in the interest rate trend, one thing we always look at is the United States Fed Fund rate, Federal Reserve rate, because United States stock market is the major stock market in the world. Actually, it's the #1 stock market that every investor or trader will always put their focus on. Yeah. Now we know that the current interest rate is 2.25. Yeah. What happened next? December, the Fed Fund meeting is going to be held soon. And also what happened to next year? What is the outlook? Is there a way for us to forecast with a quite a high level of confidence? Yes. You can go to this investing.com central bank Fed Fund Fed rate monitors. Here you can actually look at what is the forecast with a quite high accuracy that whether the interest rate in the United States is going to increase in the next meeting. So the next meeting will be held on the 19th. And what happened? So from here you see now 20.8% is a current level. This means based on the consensus, only about less than 21% of the decision maker think that no, interest rate is going to stay, but the rest of it, about 80% of the surveys give rise to a higher interest rate. That means eventually, based on this 80% of the consensus of a higher interest rate, most likely you will see the interest rate hike. Yeah. And what about January? So January, of course, if this really hike to 2.5, in January indicated that no, it still remain unchanged. But when you flip to February, March, April, May, June, July, you can see there could be another hike after this December hike in maybe May or June. So when you look at this probability, when you look at in a percentage based on the survey, you will know that roughly December most likely will hike. Maybe in May, June, another one, and end June, end of 2019, where likely there will be another one. Of course, before that, everyone expect it to be 3 more highs in 2019. But now look at the current impact on the trade war, or maybe even the softening of the GDP globally. There could be only 2 interest rate hikes, but it's still too early to tell, because if the GDP in the United States and also the other economic data and statistics show a very favorable GDP growth, and also there's a threat of inflationary pressure, then there could be 3 hikes next year. But most likely, based on the current scenario, there will be another 2 hikes in the United States. And of course, I have to say again, we are talking about the local KLCI. Why are we talking about the United States? Let me tell you, if there's a recession, if the market crash in the United States, I'm very, very confident that 99% of the chance local will be affected. If United States stock market crash, I have zero confidence that Bursa Malaysia will hit a new high of 1930, for example. But I'm very, very confident that if United States is facing a recession and the stock market crash, major correction, or maybe eventually Dow Jones drop below 20,000, I'm very confident that local market will follow suit to go south. That's why we need to know what happened in this major stock market in order for us to have a better assessment. Because if we only look at our internal Malaysia GDP, interest rate, foreign exchange, FDI, all this, is not good enough for us to assess what is the direction of FKLI and KLCI. So we have to look at what is the major influence in the worldwide stock market. That is, we can look at Dow Jones index as a very good indicator for us to add confidence to our local market in terms of the direction. And also another reason why we always look at this is because most of the largest fund managers are from the United States. And they also have a lot of fund invested in Malaysia. So if anything happened in the United States, definitely their investment amount, their investment strategy will affect our local market. Yeah. So of course, for the last 2 and 3 days, you know that everyone is talking about yield spread, yield spread. The yield spread between the longer tenor against the shorter tenor. And 2 days ago, finally something happens, which is the longer yield against the shorter yield. For this chart is 3 years against the spread between the 3 years and 5 years Treasury. That means the interest rate or the yield of the 5 years interest rate is actually lower than the 3 years. To them, it's very, very alarming. Very, very alarming. That means if the 5 year is trading at 3%, for example, the 3 year is trading at above 3, maybe 3.01, 3.02. That means the yield is negative, below 0. Because in a normal market condition, almost all of the longer tenor yield or bond rates or interest rate on deposit have to be higher than the shorter tenor because of the credit risk, because of the liquidity and some other reason. So the yield curve is upward sloping. But this one look like that is like you have an inverted yield curve. The longer tenor is lower than the shorter tenor. So this is very alarming. Why? Because history tells us that when this happens, this will reflect something major negative happen in the market. Let us review what is going to happen if the yield curve spread turn 0 or negative. So what is the significance of yield curve spread as an indicator for an impending recession and bearish market? Now you know that investor and trader actually look at the yield curve spread. That means the difference between the longer term Treasury minus the shorter term Treasury as an indicator market is going to head to a recession. And of course, when you have recession, what happened to the market? Down. That is the only way. Yeah. Of course, just now we look at 5 years again, 3 years. But actually, everyone look at 10 years minus 2 years as a very critical indicator. Of course, when 5 year minus 3 year is negative, what they expect is very soon, maybe in the near futures, maybe in the next few months or next few quarters, 10-year Treasury when it minus the 2-year Treasury yield, it will give a negative spread. You can look at this chart from the Federal Reserve Bank of St. Louis, yeah. And the shaded level actually talk about recession. So these 3 periods. For the same slide, if you go back to another 10, 20, 30 years, you can see the same thing. That means when the 10 years Treasury minus the 2 years Treasury drop below 0, that means negative. That means 10 years Treasury yield is lower than the 2 years Treasury yield. Within roughly about 1 to 1.5 years, the economy will go into the so-called recession period. Of course, when the economy register a recession period, stock market will be at a bearish tone. Yeah, that means what is this recession? When a GDP growth rate drop 2 quarters consecutively, a lot of people, or the standard definition, will term this as a recession. Yeah. So when 2 quarters of GDP growth is negative, recession, then stock market will definitely already drop. Yeah, basically. So they want to use this indicator, the 10 years minus the 2 years rate, to find out when the next recession is going to hit the market. So based on the historical developments, roughly within 1 to 1.5 years, the most about 2 years, you will see recession after you see the negative yield spread. And let us go back all the way to almost 100 years. Yeah, you can see whenever Federal Reserve increase the Fed fund rates, when the Fed fund rate, of course, like we go through the first few slides, affect the net income, affect the earning per share, eventually the market just will crash. And of course you say, now it's 2.25. When is the expected rate it will trigger a crash, will trigger a recession? Of course, nobody can tell you exactly what is the trigger point. You can see can be as low as even 2%, as high as even 80%, then only trigger a crash. Why? Because of interest rate and also the company performance and GDP and earning per share, all are relative terms. When the economic growth is very strong, earning per share is very strong, you have a very big margin for you to absorb the impact of interest rate rise. But if your profit margin and your earning per share is very narrow, even a 0.25 increase in the interest rate will have a very significant impact on your bottom line. Of course, if you think that now we see this first negative, and maybe in the next few months, we see a negative spread between the 10-year Treasury against the 2 years, then if you calculate the number of interest rate high for the next 2 years, maybe about 4, plus this year, December, about 5, then you can safely say that maybe this round, the interest rate level in terms of the Fed fund that may lead to a major correction of the market at about 4%, slightly below 4%. That could be a expected timeline. Of course, this is only based on the current prevailing development in terms of the trade war, in terms of the GDP, in terms of the global GDP growth. If the GDP growth continue to increase, then maybe even another 3 to 5 years, you don't see a crash. So all this you have to monitor closely, all the significant data released, especially from the United States, from Japan, from China, these top 3 economy in the world, because their GDP growth will have a very significant impact in the global economy and also the global market. Okay, we know what happens in overseas. From there, roughly, you know, now maybe the market is still okay currently. Let's look at the chart. Yeah. Of course, most traders, when they want to trade stock and also index, they will look at what is the chart and what is the price movement and direction. One of my favorite indicator in technical analysis is I use Bollinger Band. Yeah, Bollinger Band. And this is the upper band, this is the lower band, and this is a moving average of the period. Normally, the predefined period is 20, but to me, as a trader, I use 10. Yeah, I use 10. I still use 2 standard deviation. So what is the significance of this? You see, when the market is trading on the sideways, the band narrow. And then when something happens, the band will expand both sides. If the index drop below the middle line or the average line, this indicates the market is bearish. And if you look at this part, when the band expands, but the prices move up, touch the upper band, this indicates the market is on a rising or the bullish trend. Yeah. So this is the latest. From here, we know that the market has been trading below the average line for the last 2 months. Yeah. And this is a weekly chart. When we look at individual counter, when we want to trade individual counter, we can look at daily chart or even hourly, 30 minutes, 15 minutes, depends on what is your trading strategy. Even 5 minutes or 1 minute, if you think that you are a very, very active trader and you are trading something that move very actively, like structural warrants, like penny stock, like futures, then maybe you should look at 1 minute and 5 minutes. But if you want to go for investment, then you look at daily and weekly chart for your holdings. And to me, in order to assess what is the general direction of the market, I can't look at daily because daily is just too volatile, do not really tell a lot of things. But I would rather look at weekly. So for the whole week, they will form one bar. And from this, I will know roughly the direction of the market because the market will not change on a daily basis. For example, today drop 30 points, tomorrow up 20 points, and next day up another 20 points, and the next day drop 30 points again. A normal market will not move in this manner. Even a stock shouldn't move in this manner. So that's why when I look at daily, then I don't have a very good feel and also don't have a very good assessment on the outlook. So I always look at weekly, yeah, because weekly can eliminate or discount all the short-term movement and also short-term market or trading psychology. So when we look at this, we know that technically KLCI or Bursa Malaysia, based on solely on the 30 stock, is trading sideways. And because of it's still below the middle line, I would say our outlook is still not very favorable. It's like we are defending, we are trying to hold on to this level. But as long as there's no significant positive development in the country, then I would say KLCI, the outlook will be sideways and also on more on the downside bias to me, solely based on this. But again, I will not rely on a single index based on the technical analysis. Yes, I know that I'm trading KLCI, FKLI futures. I should look at this. But is this the only way? Look at the support resistance, look at the volume, look at other indicator, and try to find out what is the direction. Yes, of course, you are a chartist, you are technicalist. Normally, this is what people do and what they could do. But to me, not only that, I embrace technical analysis and indicator, I also add in a bit more on this. Because to me, no matter how we say technical movements, whatever chart that you see, whatever formation of the bar that you see in the chart, basically also derive from the formation from the individual. Now we know that KLCI make up a 30 component stock. That means the daily movement of the chart affected by 30 stock. Because the KLCI don't move by itself. Actually, it's just a reflection of what are the movement in each of the individual counter. So we look at the component stock. We have 30 component stock. But again, if we look at each individual counter, we are wasting our time because this is the market cap weighted index. That means the largest stock have the largest impact or influence on the movement of the index. So we know that, for example, the 4, 5, top 6 counter actually make up more than 50% of the weightage in the entire KLCI movement. That means if you only spend a bit of time to look at the top 3 to top 5 counter on a daily basis, it's good enough for us to gauge what is the general direction of the market. Yeah. So, you know, our top 3 is Maybank, probably TENAGA, and also Petronas Chemical, and also CIMB. So if you know what is the direction of this few counter, you can easily forecast what is the direction of the entire market. Because when you trade FKLI, this is what you want to know. So when we look at Maybank, we know that, okay, Maybank maybe is doing sideways. Not too bad, not like few months before, since September dropped all the way to November. Now, end November, early December, look like Maybank is on a stabilized, yeah? And what about public bank? Of course, everyone knows that public bank is like a safe haven. Unless something major happen, public bank share price always can stay at a very stable level, yeah? So we know that sideways and maybe slowly inch up. What about TENAGA? TENAGA, you know that actually is quite choppy compared to the Maybank and public bank movement. So technically, TENAGA dragged down KLCI movement from time to time. Like this is a big drop, go back up and drop again, and drop again. Yeah. So I only give you 3 counter. You can go back and see what happened to Petronas Chemical, what happened to CIMB and other major component stock. From there, combined with your understanding of technical indicator and also the trend line, definitely I would say you are a lot more better than people who only try to forecast KLCI based on trend line, support, resistance, if they don't even look at what causes the the movement in the KLCI in the first place. So of course, a lot of you say that, what about other counter? Because I do a lot of trading in other counter. Then you say, okay, you can look at FBM 70 index movement. Of course, this one also 1 week chart, the weekly chart. Each bar indicate 1 week. You can see actually since September, the entire FBM KL70 as an index has been trading downward. Now maybe sideways. That means if you base on FBM 70 and also KLCI, you know that our market either you can term it as sideways, sustaining, or maintaining, but it's not going up soon unless you have very significant factor in the market. Maybe also not dropping because technically our GTV of about 5% is one of the top in the world. So regardless what happened globally, if you only talk about GDP alone, Malaysia is one of the best performing. Of course, if you read articles maybe one week ago or 3-4 days ago, Malaysia came out top. That means number one in the entire, I think the list is 20 country. We are number one in the emerging market. We are number one in the emerging market. So our market, not too bad, but in order to move up, we really have to have strong factor. Okay, we already cover the stock market for FKLI. Now let us look at the palm oil because FCPO is the benchmark in the world for palm oil pricing and also is the most actively traded future contract for the last 30 over years. So what are the major factors that cause price volatility in this palm oil? So basically, there are many factors, but I just want to list out 5 main factors that affect palm oil prices. Of course, affect palm oil prices means that affect the FCPO movement. Palm oil is a commodity, so you cannot run away from supply and demand. So basically, supply and demand, we talk about the import, export, and production. We import a little bit, we export a lot, and also what is the production on the monthly basis. So import plus export plus production, you will see one is the end stock. Up or down, it will affect the value and also the price of the FCPO movement. After I will show you some data. And of course, competitors, price of competing vegetable oils. The closest competitor, of course, is soybean oil, maybe sunflower seed, corn oil. So all this oil, when you look at their price trend, definitely it will affect our local palm oil price trend. So if their price drop, definitely our price will be affected negatively. If their price increase, then maybe we can sell more. Then we can sell more. Then we can export more. Of course, this is a commodity plantation. The crop will be affected by weather patterns on the growth of the tree and also when you harvest the palm oil. Heavy rains will cause flood and will hamper harvesting. And dry spell will affect growth of the oil palm and eventually definitely will affect the palm oil production. So you can see from this, definitely eventually it will affect the production and also the end stock of palm oil. Another one is import policy of importing countries. Yeah, we export a lot to the to US, European country, China, Pakistan, India, and all this. If they impose more stringent policy for palm oil, then we may have a hard time to export to those countries. Maybe our quota, the volume will be affected. If affected, of course, if the production is good here, end of the day, we have a lot of stock remain in Malaysia. If we have overstock, means what? Of course, the palm oil price will drop. Yeah. So it's very important that whether they have a very friendly or whether they have a more stringent import policy when they import palm oil from Malaysia. Last but not least is the changes in taxation and import duty. Like a lot of time, we always see, maybe India, maybe China, or maybe others major importing countries, they want to increase their import duty. If they increase their import duty, definitely will affect the price of palm oil because we need to pay more tax. Then, in a way, it will affect the importer. So if they import palm oil after they add on a higher import duty, then the cost of their palm oil could be higher than the item number 2, other competing vegetable oil. In this regard, maybe because of that, up to a certain level, they will start importing more other competing oil relative to palm oil just because of other oil may not have so much or so high import duty and make it a cheaper version or cheaper oil to import. So in this regard, when there's any taxation or import duty changes in other countries, in the other importing country, this will definitely affect our export. Yeah, when it affect our export, definitely it will affect what is the price outlook and the price trend in the CPO and FCPO. So from this chart, you know that palm oil production is actually quite volatile. Yeah. Sometimes you can see 2 million tons. Sometimes you can see less than 1.1. Sometimes it's like even below 1 million tons. Yeah, you can see from here. Yeah, that's why this volatility of the production directly affect the price outlook of FCPO. Yeah, basically production has direct relationship to weather. Yeah, weather. Yeah, and based on the historical developments, normally the supply, the production of palm oil increased from March to September, October, and decreased from October to February. Of course, when the supply increase or decrease, when we keep other factors constant, this will directly affect whether the palm oil price will rally or fall. Yeah, so we need to know this seasonal cycle if we are talking about position. Actually, hedger need to know because hedger actually maybe lock in their future 6 months, 9 months ahead. Trader maybe only keep for that 1 day, 2 days, or 1 week. May not be so critical to you. But if you are positioned a swing trader, this is a very difficult, very critical piece of information for you to make decision whether we want to long or short the futures. So FCPO prices show seasonality behavior due to this seasonal supply cycle. So from this MPOC, you can see the production and stock. Yeah, like I say, export, import, plus production. The balancing is what is the end stock. Of course, if the end stock increased, price of CPO, FCPO is expected to drop. If the end stock reduce, price of CPO, FCPO is expected to rally. Of course, this is only talking about a few factors. You have to also look at other factors. Yeah. So you can see just now we see, you see, March to September, October, most of the months actually point to a rising production. This is 2018. You can look at 2017, also the same thing. You can see the trend is on a rising trend. And then subsequently, after October, November, actually the production is dropping. Year in, year out, roughly that is the seasonal cycle. And the next one is, what about the export and import? Yeah. So for this, you have to closely monitor, because the production plus the export and import will lead to what is the end stock in the country. And of course, the end stock will definitely have a direct import. Eventually, what is the market outlook of CPO and FCPO? Yeah, we can look at this. And of course, the competed one, when you want to export, we also want to know who are our competitor and what are the changes. So we know that Bursa Malaysia could be used to be the #1 in the world, maybe 20 years back or 30 years back. But now, for the last easily 20 years, Indonesia has been the #1 exporter of palm oil in the world. Malaysia account for about 30%, and the rest is considered very, very small. Because the more fundamental factor that you know, the better is your forecast eventually. Yeah. And if you want to look for more information about this production, export, import, and end stock, you can look at the ABC of Malaysian palm oil industry. So you look at MPOA, Malaysian Palm Oil Association, Malaysian Palm Oil Board, and Malaysian Palm Oil Council. And also on the commodities control side, you can see a lot more stock data, production data. Yeah. So with this, definitely you will have a better chance to predict accurately the price outlook or trend. Yeah. So let's go to section 2, ability to sell. Yes, this could be one of the most critical factor why trader like to trade futures. So when you talk about sell, first we talk about if you create a short position. Short position is a position created by selling something first and then buying it back later. If you have been a stock trader all this while, the only experience you have is I buy first and sell later. But future allow you to sell first before you buy back. When you sell future, you don't need to have anything at all. So this is called naked short. You do not own the commodity while selling. That means when you sell FCPO, actually you don't own any crude palm oil at all. You don't need to. This is called a naked short. Of course, the cover short is you have already owned some underlying. And of course, you as a short seller, your expectation is after you sell, the price will drop so that you can buy back at a lower price. If I use Maybank as an example, then I can short Maybank at 10 ringgit. And if I expect Maybank to drop to 9 ringgit, then I will cover back. That means I will buy back Maybank futures at 9 ringgit. So I will make money about 1 ringgit. Yeah, this is short first. So this is the sell high first and buy low, buy at the lower later strategy. So a short future position is entered by a speculator to profit from a fall in price, like what I cited just now. And it can be used by a producer or hedger to lock in a forward or the future price of commodity is going to sell in future. So if this is the oil pump plantation owner, they know that they're going to harvest their oil 6 months from now. And they know very well that based on the seasonal cycle chart, the price is going to drop 6 months from now. Yeah. What they want to lock in is they want to sell first, because if they don't sell now, 6 month futures, maybe if they sit on it until 6 months later, when they want to sell at the spot rate, at the cash rate, the price is much lower than now. And arbitrager can also short sell futures to benefit from arbitrage position. If you want to know more about this, hedging, arbitraging, and all this, please go to the email sent by Casey Lau and click on the link for my last 2 webinars. I have quite a number of examples to show you how to hedge your position. Yeah. So basically, there are 4 types of short selling that you can do if you want to do short selling in the market. One is a scalping. Scalping is a very quick in and out type of trading. Yeah, it's even much smaller, much faster than the so-called day trading. What they intend to do is the scalper want to make maybe 1 or 2 ticks as a profit target. Likewise, 1 and 2 ticks maybe is their maximum cut loss positions. Yeah, most likely they try to make a few ticks. If not, they try to break even. Yeah, and day trading can open position in the morning and close before the day close. Yeah, before the trading day close. And the swing trading may hold for a few days and a few weeks. So they want to capture the swing of the price movement, either up or down. They want to trade on the cycle of the price movement. And of course, if you think that you want to hold long position and you know fundamental very well on the palm oil market, then you may just short the commodity and wait until the price drop to your targeted level. You may hold it for 3 months or even 6 months if you really have that confidence based on the fundamentals and technical analysis that you conducted. Now we talk about a bit of a strategies in the bearish market. Yeah. So if you have a very bearish outlook, what you can do is you just do a directional trade like what I mentioned just now, the fundamental short. You just short sell a futures. Yeah. After you short sell, of course, even before you short sell, you need to establish based on your technical or fundamental analysis, what is the target profit level? Of course, target profit level, you can always move it if you get more and more latest development in the market to support your view on a continual bearish outlook. You can even move your take profit level lower and lower. But one thing, when you move your profit level, you will also have to adjust your cut loss. Of course, before anyone open any position, you should set your take profit and cut loss level immediately. But these 2 levels can be adjusted accordingly every single day when there's a new development in the market. But please, you can't adjust your profit level only. You have to always adjust your cut loss level. When you move your profit level to higher level, you have to move your cut loss level follow closely to the profit level. Likewise, when you short, you move your profit level to a much lower level. you also have to move your cut loss level accordingly. This is to protect your profit. If you don't adjust your cut loss level in line with the movement of the profit level, you will lose all the big profit potential that you have been enjoying. So if you have a moderately bearish outlook, what you can do is actually you can just buy a put option to speculate or to protect or hedge against your existing long position. So you think market is not going to crash, but the outlook is still dropping. And if you are holding some cash position, then you can buy a put option to lock in or to protect your current position. If you don't hold any underlying, you buy put option, you just want to make money from the price movement, and after you buy, of course, eventually you sell the put option and you can capture the difference in terms of the premium. That is your trading profit by buying and selling a put options. So if you have the lowest level of bearish outlook, then you can sell a call option to collect option premium. Yeah, this one you earn the less. Yeah, but all this you have to put in your risk management measure, and minimum is to put a cut loss limit. Of course, position sizing, capital management, all these things you have to manage. So when we look at this daily price, you see from early October all the way to November, actually constantly the price have been dropping. And if we do a brief calculation, in less than 2 months, FCPO dropped 400 points, which is equivalent to about 17%. So 400 points times 25 ringgit per point, actually within 2 months, you'll make 10,000 profit for one contract. Oh, it's a lot of money. If you make 5,000 salary monthly income, definitely this is like your 2 months bonus in 2 months time. Yeah, but this is for position trader or fundamental shorting. Yeah, because you hold your position based on what you see. Yeah, maybe one of the way that you use is you look at this exponential moving average. Yeah, when it's dropped below, it's still below the 6-day or 5-day moving average, you still continue to keep. Yeah, this could be one of your strategies. And what about this weekly chart? So from April this year all the way to late June, actually the market has been dropping from about 1,880 to 1,009 level all the way to 1,660 level. So if we do a brief calculation, in less than 3 months, KLCI dropped about 200 points, which is about 12%. And each point value at 50 ringgit. So coincidentally, you also make 10,000 ringgit if you are shorting. Of course, if you are long in this FCPO and also FKLI, sorry to say that your money 10,000 just transfer to the one winning, because FCPO or derivative technically it's a zero-sum game. People make money from loser, yeah, zero-sum game. And before you start trading every day, what do? Of course, you want to look at the major overseas market. Like what I said, Dow Jones is the #1 market in the world. Definitely, you have to look at it. If you are a FCPO trader, minimum you have to look at what is the market trend in the United States for soybean futures. Yeah. So good about these two is we can always refer to what is the closing, what is the trend in Dow Jones in terms of the stock, in terms of some of the oil futures, to be able to know that roughly today, it will follow the same trend. Technically, when Dow Jones drop a lot, our stock market most likely will follow, at least from a start. But when Dow Jones rally, this may not be the same because the factor supporting the Dow Jones rally may not be seen in Malaysia. Yeah. Oil, roughly, they follow very closely. Of course, is there any major news, data release, or development in local and overseas market yesterday, today, or next few days? Yeah. Any major development in the index component stock, like what I say, Maybank, Public Bank, TENAGA, Petronas Chemical, and CIMB, all these have a big impact on the KLCI movement. So if you are FKLI trader, you really need to monitor those counters. What about the important support and resistance? A lot of people will take this as a very major support and resistance level. So you look at the 200 days, 50-day, 20-day moving average. You will know roughly now the trend is on the uptrend or downtrend. So when we look at this chart, just now I said this is like 200 days, 50 days, 20 days. You can see, of course, like what I say from the weekly chart just now, this is below 200 days and below the midline of the moving the Bollinger Band. So technically, if you really based on this trade line, based on Bollinger Band, our KLCI is still sideways or on the more bearish bias. Yeah. Of course, you can see whenever is on the above the shorter line and cross from the bottom to a longer tenor line, you know that everyone is looking at a more uptrend bias. When it's do the other way, the 50 days, the 20-day cross below the 50 days, you know that the market is very bearish. Yeah, this is the normally trader will term this as like this is the golden cross, this is the dead cross. Yeah. Similarly, when you look at this MACD, also the same thing. Yeah, when you see this blue line cross above the red line and above zero, above the reading of zero, yeah, you can see the trend is on the uptrend. So that's why a lot of people, especially for the position trader, they hold a longer term, they like to look at major trend line and also MACD. And Bollinger Band, just like I told you already, I like to look at this whether it's above or below the average line. Yeah. Another one is if you are a FCPO trader, I think this one is something quite familiar to you. That means almost on a daily basis, you can always see either the morning you have a gap up or down, or afternoon 2:30 there's a gap up or down. If you are a position trader, you know that you want to trade on trend. Maybe this is not relevant to you because you are not worried. But if you are a day trader, anything gap up or gap down, you definitely either make you a lot more money or cost you big losses. So personally, actually, I don't like to. I'm a day trader, but I don't like to hold my position for the whole day. What I do is I open position in the morning and I make sure I close before market close for the morning session, like 12:30. So I will close my position at 12:10, and then I will go for a happy lunch. After that, I don't care whether jump up or down. I'm safe in terms of my position. Yeah, and then I look at indicator again and do trading. Because unless you are very, very lucky, you always can capture a lot more profit in terms of the gap up. If not, whatever money you make in the morning, you may just give back or even double in the market if the gap up or down is against your holding. So to me, my strategy is, and I want to have a very happy lunch So I close it. Similarly, if I open any position in the afternoon, I will close it about 5 plus, yeah, before I call it a day. Why do you want to bother to hold a position if you are a short-term, very short-term day trader? You can't sleep at night when you see the oil price movement in the United States and other countries move against your current position. This means the whole night you can't sleep. As a trader, you shouldn't do that to pressure yourself. And also, if you are a very short-term trader, you look at the 5-minute chart. Something similar to this, what I explained just now in the Bollinger. When the market is sideways, you can see the range movement is like range bound, and you can even draw a box, yeah, in it to capture. So the upper end is your resistance, the lower end is your support. Most likely, if this one prolong for a long enough period, when it breaks up or down, it will continue the trend. This means if break down immediately you short, most likely you can make some money. If break up immediately you long, most likely you can make some money. Yeah. Of course, the longer is the box, the more solid, the more confirmed is the breakout trend. Yeah. So this is one way to see it. Of course, beside this, I also look at the volume. If the breakout come with a huge volume, wow, this is very, very solid. If the breakout come with not much volume, maybe I want to hold on for a while, yeah, to observe further, yeah. Another one that I want to point out to you is the bid and offer price and also the volume. If you want to trade any contract, be it FCPO, FM70, FKLI, or any other contract, you want to make sure you are trading a very liquid contract. Yeah. So you can see, if you trade this February 2019, we know this is an active month. You can see the total volume and also the bid and offer volume is high. Yeah, the bid and offer volume is high. You don't want to be caught in the scenario that after you buy this, for example, this is March 2019, after you buy this, you take the offer, there's no more offer. Yeah, or you give the bid, there's no more bid. That means you're caught in the situation that if you want to cut loss, you cannot. So make sure every time you go for the contract with very narrow bid and offer price and also very sizable bid and offer volume. Yeah. Don't go for very thin one. This one even worse, don't even have an offer. So try to avoid. Yeah. Unless you are a hedger, if you are a spec trader, to you this is not really relevant. Yeah. So I already completed all my slides. And actually, Bursa Malaysia still have one more option class in JB on the 9th of December. That means this Sunday. So if it happen in JB, of course, you can register for it. Yeah. So this is the QR code that you can take a picture or scan in order for you to register for these futures. And yeah, actually they have many future seminar, but this one is already in the past now. That is the last one to be conducted in Johor. Yeah. Maybe next year they will have more future and option courses, but you have to monitor Bursa website and KLCI website if they work together again. So 4 key takeaways. We know what causes the market up or down, and we know that one of the best thing about future is we can sell first. And of course, I showed you a few strategy in the bearish market. And now, finally, beside the normal buy sell, you know that in some of the market, they have some unique signal that we need to monitor, because not all market have the same characteristic or signal. So each new market that we want to enter into, make sure we know what is happening in this new market. So I also show you one palm oil economic outlook review and organized by the government body MPOB, Malaysia Palm Oil Board. You can register, and if you want to know more about this, especially if you really a big trader or investor, definitely from time to time you want to attend this, because normally they will invite a lot of market participant, expert to give their outlook, and technically what they say in all these conferences is quite impactful eventually. Yeah, so if you know it on the first hand basis, definitely will help you in your trading and investing journey. So if you want to get more information about future, you can go to bursamarketplace.com and you register if you have not registered. And from there, you register and you look for future. You look here and get a button, futures. Yeah. So with that, thank you for your attention. And if you want to follow me, you can look for Warren Mark, and this is my company website. And of course, feel free to write to me if you want to have any conversation about the market. Thank you.
That's great. Wow. Warren, thank you for all the strategies and all the unique signals on the market that I think a lot of takeaway for the people attend today. So if you have any question, you can type in the Q&A box. I think this is the best time to do it if you have any specific question you want to ask Warren. If not, we are going to end the session pretty soon. So sounds like you have given us a very, very good explanation, and there are no further question, right, from them. I think they fully understand what you say. That's nice. Oh, suddenly pop up one question.
A few questions in the chat box.
Say one is this is from Victor. Said if we trade or invest foreign shares, do we need to declare taxes in Malaysia?
This is tax. It's beyond the scope. Maybe you should have a tax accountant. Your tax accountant. Yeah. But technically, trading in the local market in terms of capital gains is tax-free. Yeah.
Yeah, basically in Malaysia it's tax-free.
Yeah, Malaysia.
And another question from Kumara, what would be the health level of investment needed in cash?
Level?
Yeah, I guess the question will be like, how much cash is required to do the trading, I guess, in the future?
Investment?
Yeah.
This is a future session. Let me talk about future first, yeah? If you want to trade on future, to me, most people will start with trading one lot. One lot currently, the initial margin is 4,000, 4,005. So even you have 7,000, 8,000, it's good enough for you to start trading. Yeah. Of course, when you increase your position to few lots, then maybe you have to increase to 20, 30, 50,000. Yeah. And depends on your strategy. If you're a spread trader, the requirement for initial margin is much lower. Yeah, maybe it's only about few hundred. And you trade FM70, the current initial margin is 900. So if you trade a few lot, even 6,000, 7,000, it's good for you to start. Of course, if you have 10,000, it's more safe, because if not, it may easily trigger your initial margin. But based on my experience, I always advise people, if you receive a margin call from your broker, for example, if you start with 4,005 initial margin and your initial capital, you put in about 8,000, I will definitely not advise you to top up your margin if you receive a margin call, because that only shows that you really hold a very wrong long-term position. Or if you keep on trading and keep on losing, you are really using a wrong strategy. Yeah. So either you hold a wrong position because your outlook is wrong, or you keep on losing money because of you don't really have a good strategy. You should actually take a step back, stop, and then try to review what happened to your strategy. what happened to your assessment to the market. Otherwise, based on my strategy for the last 25 years, I see too many people after the top up margin, most likely they lose even more. Yeah, this is the first thing I want to talk about. Of course, if we talk about stock, it depends on what kind of stock you want to invest. If you want to hold a long-term public bank, if you don't have 100,000, technically to me, you're wasting time. Yeah, but you are talking about doing trading in structured warrant, maybe 10,000 is more than enough for you because that is a trading instrument. So it depends on what is your position. Are you a trader, investor, long-term or short-term? It will have a bearing on what is the requirements. So if you don't give me a bit more information, it's difficult for me to advise you on that. Yeah.
Yeah, thanks for the explanation. And someone is asking for the webinar replay and also the slides. So after we end this webinar, you are going to be taken to a survey page. And please kindly do the surveys. It will take you just 1-2 minutes. After it is done, then there's a link for you to download the full slides of this webinar. And we also have the replay on my Facebook page. It will be there. And also on my website, kcl.com/webinar. You can check that out after this. Because this series is a sponsored event by Bursa Malaysia. So basically the recording, I will put it up on the website as long as it is there. So once again, this derivatives webinar is an educational initiative brought to you by Bursa Malaysia. So thanks everyone. And we are going to have the final one in Mandarin. If you learn Mandarin better, if you learn better in Mandarin, then do check out the session. This is going to happen the coming Tuesday. The coming Tuesday. Yes, correct.
Yes.
On 9 p.m.
Yes, 9.
Same content in Mandarin. So we'll talk to you soon.
Okay, thank you, Casey. Thank you, everyone. And all the best in your 2019.
Thank you. Bye-bye.
Bye.